Okay, guys, I'm back in the studio, and I've got a stack of paper back there that we're going to go through. There's so many headlines and news articles that I need to talk to you about. Everything from a lot of layoffs, as you know, are coming, but also there's a few other things that are very important, the GDP for the whole country, and about 2 dozen other things. So we're going to get to it really quickly. I'm going to fly through this one, and we'll get into other stuff in the next videos coming up. But for now, this one, I'm just going to do all of the paperwork. We'll go through all these headlines that I want to mention. From CNN. A growing list of companies are announcing layoffs this year amid concerns about economic uncertainty, as well as the need to cut back after going on a hiring spree during the pandemic. Disney, BuzzFeed, Lyft, and Deloitte are among the list of major companies that have reduced their workforces this year. The tech sector has also been hit hard over the past few months following mass layoffs in 2022. Amazon, Meta, Microsoft, and PayPal have all axed thousands of people. And to take a step even further, they've even announced, those same companies have even announced that there will be more layoffs to come. A lot of times you see a big wave of layoffs, and that's just the first tranche of it. Then they come back, they don't want to announce it all at once. They don't want to say, we're going to lay off 100,000 people. They say, we're going to lay off 20,000. And now we're going to do another 30,000. And they add it up, and that's how they get the big layoff numbers spread out over the news cycle. This comes as first-time claims for unemployment benefits rose to 245,000 last week. That's very slightly above expectations, and that's according to the data from the Department of Labor. And talking about how the employment expectations keep coming in below expectations, that signals, it says, the Federal Reserve's year-long rate hiking campaign to chill inflation is now also cooling the labor market, as it was always intended to do. The debt ceiling showdown is fueling fresh fears that the U.S. is heading for a default that could hurt millions of people. Unless Congress raises the federal borrowing limit this summer, analysts say the government will run out of money, the U.S. will be unable to pay its obligations, and the economy could tumble into a recession, causing job losses and possibly halting payment of some benefits. I just got to take issue of one part of that. It says the U.S. will be unable to pay its obligations, and the economy could tumble into a recession. The one thing I want to mention about that is that the economy is going into a recession. 100% for sure, no questions asked at all, for sure. It's just a matter of when. Does this happen 2023? Does it happen the year after that? If it doesn't happen then, it'll be the year after that. If it doesn't happen then, it's the year after that. For many of you, this is your first time here. My name is Peter Leeds, and along with my extraordinary team, we publish one of the most popular financial newsletters of all time. Nothing we say in this video is intended as personalized trading advice for you. The recession will be here. We're on the edge of it right now. And I'll show you in some of these headlines that we're going to get to about the GDP. It shows that it's slowing down pretty markedly already. This is from CNBC. U.S. GDP rose at a 1.1% pace in the first quarter as signs build that the economy is slowing. Gross domestic product rose at 1.1% annualized pace in the first quarter, below the 2% estimate. It's only half of what the estimate was. They were expecting 2%, they got 1.1%. Lyft to cut 1,072 employees, or 20% of its workforce. And they actually go a step further. Lyft says that they're actually not going to hire. They're going to put a hiring freeze on certain positions. They were looking for people for those positions. They're just going to not hire anybody now. That's a way to fire a person before you even hire them. Fear gauge breakdown means stocks are set to break out, says top chart analyst Katie Stockton. I would tend to agree with her assessment. The fear index, which you can't actually trade it, but the VIX, the volatility index, is the same thing. When people get frightened, you buy more put options. And so, because you're betting against the market or whatever sentiment of the economy at that point. So what a lot of investors do is they buy put options, betting against the stock or betting against the overall market, whatever they invest. And the VIX gauges that. It sees the more negative activity, the more put options buying, that means it goes up. And so that's when you see negative things happening, you see the VIX spike. You can't invest in the VIX, you can't trade off the VIX. It's not like an actual stock, but it's a great indicator to show you when people are afraid in terms of the mindsets of investors. And what Katie Stockton is talking about in this article is that with the fear gauge, or the level of fear, dropping pretty markedly, pretty significantly, that means people are ready to get back into the market. They're not as afraid anymore. They're not as uncertain. So a lot of that money is going to go in and possibly drive overall shares higher. That's her premise in this article, which I do happen to agree with. But just keep in mind, it's all temporary. It'll be a temporary bounce. First Republic's dramatic slide continues. Stocks fall 20% as bank looks for a rescue deal. This banking crisis is far from over. Right now, what you're seeing is a lot of blames being put on Silicon Valley Bank, First Republic Bank. Oh, you managed things wrong, or there's too much leverage, too much exposure, and now it's all backfiring, and it's time to pay the piper. But there will be more problems with banks because it wasn't an issue caused by these specific banks. It was an issue with the overall banking system because interest rates were so low. Too many people, including the bank's customers, took on way too much leverage that now when rates go higher, this becomes a problematic setup. I don't know exactly when the shoes will stop dropping for the banking crisis, but that will not happen until we flush out a lot of these problematic banks. There are many more than you've heard about yet. Amazon starts layoffs in their human resource and cloud units. The layoffs are part of the previously announced job cuts that are expected to affect 9,000 employees on top of the other 18,000 job cuts that already took place earlier this year and in last November. CEO Andy Jassy has been aggressively cutting costs across the company through layoffs, a corporate hiring freeze, and by ending some experimental projects. That is exactly what, as a CEO, I would suggest that he should be doing in this particular economic environment. We're on the edge of a recession, tumbling right into it, and we have no idea yet how serious or how significant this will be and how it's going to affect businesses. We have an idea about how it affected businesses in the past and theoretically what should happen, but there's too much uncertainty right now for it to be time to start building back and making a base. You have to have the pain point first. The pain point is just ahead of us and it's going to be ugly. I don't know what form it's going to take, but what you want to do is understand that this is happening so that you can position yourself properly with your investments. There's certain things you can buy that are better than other things at a time of crisis, a lot of which we talk about on the Peter Leeds YouTube channel. You know that I'm heavily into gold mining companies. I think that gold prices are going to do very well. I think the mining companies will do even better than that. Also avoiding a lot of the riskier speculative investments, getting into companies that are paying dividends, making money, have a proven track record, or our specialty, finding companies when they're still small, a low head count, a small corporate footprint, and they pass the proof of concept phase where they have something of value that people are willing to pay for, that they can produce at a lower cost than the cost that they're going to sell it for. And it doesn't have to be a product. It could be a service, it could be a concept, it could be an online tool. There's a lot of different ways for businesses to do what they're meant to do. A business's purpose is to make money. Chrysler parent offering buyouts to 33,500 U.S. employees.
Stellantis to launch the biggest electric vehicle fleet. As the electric vehicle industry booms, new automakers are also giving it all to be part of this green revolution. A newly established electric vehicle company dubbed Stellantis doesn't want to be left out and has entered the electric vehicle industry grandly.
The global automaker is attempting to cut costs and headcount. You see the trend, though, in a lot of these articles that stood out to me that I wanted to read to you? A lot of companies are doing the right thing ahead of time. Not all of them started this yet, but a lot more will do it as they start to see the economy deteriorate. The smart CEOs, the smart companies are already looking at layoffs, are already trying to conserve costs, become more efficient, do all the things they have to do so they're going to be able to weather this recessionary period, which may be a matter of months. Most recessions are a matter of many months. But perhaps it goes on much longer than that. And given the setup economically, I'd be surprised if we get away with anything less than a protracted recession or a pretty significant depression. I'm avoiding companies that are selling luxury items. I'm sticking with things that do well in recession like healthcare, utilities, and I'm definitely getting very aggressive, more heavily invested in oil-related companies. I believe that oil prices long term are going to be incredibly higher for all the wrong reasons, but I believe it'll happen. In the meantime, I'm not sure about oil. I'm looking into it right now. the recessionary forces are going to pull oil prices down significantly. A lot of things could drive oil higher significantly as well. So it's a matter of how they line up, how long they take. My overall base case is that oil prices will come down as we go through the recession. And then we're going to be facing a pain point, which will result in an overreaction from the Federal Reserve and the money creators. They're going to douse us all with all this liquidity, all this money. They'll create even more money than they already have, which has been historically unprecedented. And that's going to give embers, fuel to this massive inflationary bounce that I'm going to be talking about in one of my upcoming videos. At that point, oil prices will be going a lot higher along with all other commodities like wool and coffee. But remember when you first heard me talking about gold. For some of you it was right now. Others it might have been years ago. But I've been consistent on gold and gold mining companies for the longest time, and I put my money where my mouth is. And if you look back to a video I did not even that long ago, and I was talking about gold prices showing more volatility, which could be marking a market bottom, a turning point, because of the uncertainty. You're seeing the price of gold swing wildly, big moves up or down day to day now. And that's generally when you see a market top or bottom, you start to see the volatility of the underlying thing increasing. It's becoming more volatile. The moves are more significant in either direction, but they're just more significant. And I think in this case, it is indicating a market bottom for gold prices. So this is from CNBC Pro. Bank of America makes a bull call on gold. Says this is the perfect time to own bullion ETFs. There's a value to being ahead of the game, to being upstream. That's why a lot of you might have been getting involved in gold when it was trading dramatically lower. And now everybody's going to come along and start saying, everyone should be buying gold. Everyone should be buying gold. I've been talking about this forever. But now that gold has woken up, as I talked about in this video not that long ago either, gold has woken up. And so now sources like Bank of America, other sources are going to be reaching out in the media talking about gold as an investment, gold prices. Gold is one of the best performing assets this year so far. And just wait until the year's over. It'll still be gold at the top of the charts. And I think that next year will just keep on going from then. It's starting a trend that people are going to notice and say, wow, gold's really increasing over time. And they look at the chart and they move their funds into gold. And if you appreciate these videos, you want to thank somebody from the Peter Leeds Army. This is why we do all this now. So that's it for us. So make sure you subscribe to get the big inflationary bounce. Hit the bell so you get alerted when that video comes out. And we love you guys. You guys are the best.